Hello, and welcome back to the quarterly investment briefing from us here at Gemini Asset Management. As we navigate through the shifting sands of global markets and macroeconomics, we've seen some fascinating developments over the past quarter. In this briefing, we're going to touch on the new macroeconomic environment that we face, equity market performance, and bond market performance. So let's dive in. We'll start with the economic backdrop, as even though we're buying companies and not economies, the economic landscape has significantly impacted the asset markets in recent years, and understanding this frames our views on major asset classes in the current environment. Chart 1, on screen now, shows CPI inflation over the last 10 years on the left-hand side, and the expected interest rate pathways for the major developed market central banks on the right-hand side. As you can see from the inflation chart on the left, we've seen substantial declines in the rate of inflation across the globe. Many are calling this the immaculate disinflation, essentially a significant easing of inflation back towards target levels, roughly 2%, without triggering the feared recessions. Contrary to historical expectations, some economies have performed well, even as interest rates climbed higher than anticipated a year ago. This immaculate disinflation phenomenon suggests a softer landing may be possible, buoyed by stronger economic activity and low unemployment rates. A soft landing is essentially where an economy goes through a rate hiking and a rate cutting cycle without causing a recession. So far, given the strong economic data that we've seen coming out of the US in particular, the soft landing has been priced into equity markets and is one of the main reasons equity markets have performed so well this year. In the UK, the EU and within Japan, recessionary feeling is expected to be relatively mild and short-lived, and so equity markets are again reacting relatively well. As you can see here from the right-hand side in chart 1, the market's also pricing in interest rate cuts throughout the next year and beyond. Central banks, in response to the falling inflation, are hinting towards the interest rate cutting cycle starting in the next few months, specifically this summer. You can see this on the chart by the market expected declines in interest rates throughout the next year, with the UK and US expected to cut by roughly 1.25% and the EU expected to cut by roughly 1.5%. With economic growth forecasts for 2024 looking brighter, global inflation on the decline, and notable expectations of central banks bringing down interest rates again, there's a palpable sense of optimism bouncing around various markets. However, there is some nuance to this point, which we'll discuss later on in the video. Which brings us on to chart 2 on screen now. Chart 2 shows the performance of various equity markets over the last quarter, and as you can see, in general, it's been a very positive period, especially for the US and Japan. Global equities surge, fueled by the positive economic news and the soft landing story, the immaculate disinflation, and the buzz around artificial intelligence. The UK's lagged other developed markets here a little bit, whilst in the US, strong corporate earnings and the anticipation of interest rate cuts propelled the index forwards. Japan also saw a historic rally in the first quarter of 2024, as it continued to attract substantial foreign investment and remains in a completely different stage of the economic cycle to the rest of the developed world. As you can see, the real laggard has been in the Asia excluding Japan equity region, which has been hindered by the concerns surrounding China. There's been some traction in the stimulus policies instigated by the Chinese Communist Party in recent weeks though, but there's still a long way to go for the region to find any meaningful recovery. So, with equity markets pricing imperfection on the economic front for the US, and flying to the moon on the idea of soft landings, it's worth noting that there's another side to the picture. The other side is what we're seeing playing out in the bond markets. With some economies running relatively well, with the US being the most obvious standout in this sense, it provides less of a supporting backdrop for central banks to cut their interest rates as fast as the market had originally expected 3 months ago. If you remember back to chart 1, the market now expects roughly a 1.25% interest rate cut in the next year in the US. But 3 months ago, it had expected nearly 2% worth of cuts in that 12-month window. This might not seem like much of a change, but for bond markets, this is massive, and it highlights a key point. With markets pricing in these expected interest rate cuts, any disappointment on these will likely lead to a negative impact on the asset performance. And we've seen this in bond markets for Q1 in 2024. Chart 3, on screen now, shows the performance of various bond markets throughout the last quarter. And as you can see, that besides the more equity-like global high yield bond index shown here in the pink, the bond markets have tended to move sideways throughout Q1. The bond landscape has essentially been shaped by the shifting inflation and interest rate expectations that we noted earlier. Expected cuts went from roughly 2% in the US to only 1.25% for the next year. So, despite initial hopes for swift rate cuts, a more measured approach has emerged following the continued strength in the US economy and slightly more stubborn inflation than has been expected, especially in the service sector. Albeit inflation is still trending lower, it hasn't quite come off as quickly as the bond markets had originally hoped. So, these factors have introduced an element of caution and have tempered expectations for the originally expected aggressive rate reductions. As you can see, there's some gripping dynamics contrasting at the moment in different asset markets. And as we progress through 2024, the interplay between these economic resilience, inflation dynamics and the central bank policies will be pivotal, and it may be that the noise around these issues could lead to a little bit more market volatility until there's more clarity on the picture. Our strategy remains the same. We aim to be anchored in the principles of effective diversification, so we're not putting all of our chips on any one outcome, specifically rate cuts or no rate cuts. Thank you for joining us for this latest investment briefing, and if you have any further questions, please don't hesitate to contact your financial advisor. Thank you.